Let me ask you something real quick. What happens when one of the most powerful people in crypto publicly tells another that his entire strategy is built on a crumbling foundation? That's not a hypothetical. That actually happened this week, and the timing couldn't be worse for the company being called out. Stay with me, because by the end of this, you're going to see this situation very differently than the headlines are framing it. Welcome to XRP Financial Horizon. If this is your first time here, we don't just react to news. We break it down to the part that actually matters to you as an investor. And today, what matters is this. Ripple CEO Brad Garlinghouse sat down with CNBC on Friday and took direct aim at Michael Saylor, the chairman of strategy, and the specific financial instruments Saylor has been using to keep piling into Bitcoin. This wasn't vague. This wasn't diplomatic. It was pointed, specific, and it landed at a moment when Saylor's operation was already under serious pressure. Now, before you assume this is just two crypto heavyweights trading barbs, hold on, because what Garlinghouse actually said cuts much deeper than typical industry drama. He didn't attack Bitcoin. He didn't even attack Saylor personally. He attacked the mechanism, the financial plumbing underneath Strategy's Bitcoin buying machine. And that's the part most coverage is glossing over. So let's slow down and actually look at what that mechanism is, because once you understand it, Garlinghouse's concern starts to make a lot more sense. Here's the core of what Strategy has been doing. For roughly the past year, the company has been raising fresh capital by selling what are called preferred securities, financial instruments that sit somewhere between stocks and bonds. One of those instruments is STRC. These preferred shares were originally issued at a face value of $100 per share. The idea is that investors buy in, Strategy collects the cash, uses it to buy more Bitcoin, and the value of the whole operation grows. That sounds reasonable enough on the surface, but there's a catch that doesn't make it into most headlines, and it's a big one. STRC comes with a cumulative annual dividend obligation of 11.5%. What that means in practical terms is that Strategy has to keep paying dividends on those shares every year, not if things go well, not when Bitcoin is up, but every year, full stop. So if Bitcoin drops significantly and stays down, Strategy doesn't get a break on those payments. The obligation keeps running. And the market has clearly noticed this, because as of Thursday this week, STRC was trading at 26% below its $100 par value. 26%. When preferred shares, which are supposed to be relatively stable, are sitting that far below face value, it means the market has real doubts about whether the company can sustain what it's promised. That's exactly what Garlinghouse was reacting to. He called that price drop a damning indictment of Strategy's model. And I want to pause on that phrase for a second because it's deliberately legal language. He didn't say it was risky or aggressive or even misguided. He said damning indictment, as in the evidence itself has already delivered a verdict. That's a very specific and very strong thing for a sitting CEO to say about a competitor's core financial strategy on live national television. But here's where it gets even more interesting. And this is the part that I think gets lost in the back and forth. Garlinghouse was asked point blank about the sustainability of Strategy's model, whether the approach of using financial instruments like STRC to continuously accumulate Bitcoin actually creates long-term value for investors. His answer was something along the lines of, financial engineering doesn't drive long-term value, utility does. And that's not just a comment about Saylor. That's a statement of fundamental philosophy about what makes a digital asset actually worth holding. Think about what he's really saying there. He's drawing a line between two very different theories of crypto value. One theory says, digital assets get valuable because people believe in their scarcity, because institutional money flows in, because the narrative builds. And that's basically the Saylor thesis for Bitcoin. The other theory says, digital assets get valuable because they do something real in the world. They solve a problem. They power transactions. They make financial infrastructure more efficient. That's broadly the XRP and Ripple thesis. Garlinghouse isn't neutral in that debate, but his concern about Strategy's model isn't tribal loyalty. It's about what happens when the leverage runs into a sustained price drop. And here's the part that nobody wants to say out loud, but I think deserves to be said. Garlinghouse also made a broader market comment that went a step further. He said that Saylor's team wasn't focused on the right things, and that this has caused damage to the overall crypto market. That's significant. He's not just saying Strategy has a fragile balance sheet. He's suggesting that the way Strategy operates, at the scale it operates, with the level of leverage it carries, creates negative consequences for everyone else in the ecosystem. Whether you agree with that assessment or not, it's a serious claim, and it came from a very credible source at a very sensitive moment. Because the timing here isn't random. This week was rough for Bitcoin. BTC slid below $60,000 on Friday after US inflation data came in hotter than expected. PCE hit a 3-year high of 4.1%. When inflation data like that hits, risk appetite across the market drops, and Bitcoin tends to feel it. But strategy, given its leveraged position, feels it much more intensely than the average BTC holder. Every percentage point Bitcoin falls translates into amplified losses across MSTR stock, STRC preferred shares, and every other piece of strategy's capital structure. And all of that was playing out in real time while Garlinghouse was making these comments. MSTR, strategy's common stock, also had a painful week. It dropped to its lowest point since February of last year, eventually closing around $82 on Friday. That's a number that has strategy's investor base doing a lot of uncomfortable math. And making it worse, CryptoQuant, a well-regarded on-chain analytics firm, published a pretty striking recommendation earlier in the week. They looked at the hard data on strategy's position and essentially said the company should stop buying Bitcoin right now and focus on building cash reserves instead. When the analytics community starts saying that out loud, you know the pressure is real. Now, I want to be fair here because Garlinghouse gave us something useful to work with from the other direction too. Even while criticizing strategy's approach, he said clearly that he's still personally bullish on Bitcoin. He's not calling BTC worthless. He's not saying institutional adoption was a mistake. He's separating the asset from the financial structure being used to accumulate it, and that's an important distinction. His argument, stripped down, is basically, Bitcoin might be fine long-term, but the way strategy is financing its Bitcoin purchases creates a separate set of risks that are not Bitcoin risks. They're leverage risks, dividend obligation risks, and structural risks that exist regardless of what BTC's price does. That's actually a really important lens for thinking about what's happening right now. If you own Bitcoin directly or through a spot ETF, the STRC situation doesn't affect you in the same way. But if you're an MSTR shareholder or an STRC holder, you're exposed to all of those additional layers of financial engineering on top of the underlying Bitcoin volatility. And the market is currently pricing in real doubt about whether those additional layers are sustainable at current Bitcoin price levels. That's not FUD, that's just what the trading numbers are showing. So what should you actually take away from all of this? A few things. First, the debate about how to build a company on top of a volatile asset is very much alive and unsettled. Strategy's model has had genuinely impressive periods, nobody can deny that. But it also has an Achilles heel that becomes very visible when Bitcoin isn't trending upward. Second, when credible voices from inside the industry start making public statements like this, it's worth paying attention, not because they're always right, but because they typically have information and context that the average retail investor doesn't. Third, and most importantly, the structure underneath an investment matters as much as the asset itself. Bitcoin at $60,000 and STRC trading at 26% below par are both real numbers that exist at the same time. One doesn't cancel out the other. As always, nothing in this video is financial advice. Do your own research, look at the actual filings, understand what you're buying and why. If you found this breakdown useful, hit the like button and make sure you're subscribed. We cover developments like this as they happen, and there's a lot more to watch as this story keeps evolving. Drop your thoughts in the comments. I'm genuinely curious where you stand on Garlinghouse's critique. We'll see you in the next one.